Welcome back. My next guest says the U.S. economy is decelerating rapidly, and if the Fed does not cut rates this year, the U.S. economy could enter a recession in 2026. He's also got some top stock picks to share with us. Joining us from New York, Jay Hatfield, founder and CEO and portfolio manager at Infrastructure Capital Advisors. Jay, thanks a lot for joining us. What is your view on the U.S. economy? You are not constructive on trends in the U.S. economy.
Absolutely. Good morning, Paul. Thanks for having me on. We're basically going through a normal tightening cycle, central bank tightening cycle, just like you folks are. You'd mentioned, the Canadian economy is weak. So we have exactly the same weakness where the old economy is going through a normal recession process. So if you look at U.S. both construction spending on the commercial side and also residential is going negative. And in fact, I don't know why investors aren't more focused on this. Last quarter, U.S. GDP had negative 1.1% investment. Keeping in mind that everybody says, oh, the consumer is the most important, but the consumer is very stable. Investment's very volatile. That's what creates recessions. And unfortunately, we think for political reasons or accidental political reasons, the Fed doesn't seem to realize this slowing. So they're super recalcitrant, keeping U.S. rates really high. The only offset that we have that you don't have in Canada is obviously we have these huge technology investments, so that's an offset. So our call is 1% to 2% growth, but decelerating. I think the Doge cuts will force the Fed to cut, so we're still constructive, still have 7,000 target. But we're neutral right now until all these things get resolved.
This is a Fed story, in your opinion. It's not a sentiment story based on the possibility of tariffs and a slowdown arising from policies from the White House. You're looking at the numerous rate hikes that the Fed made between March of 2022 and the summer of 2023 as the culprit here.
Absolutely. It's important when you're assessing Fed policy to look at the money supply. It's totally crazy that our Fed chair doesn't care about the money supply. That's like the Pope saying he doesn't believe in Jesus. So to keep rates as high as they are right now, we're shrinking our money supply by 5% a year. It's massively deflationary. And then we think sentiment's way overdone as an indicator. It's what we call endogenous indicator, just is what results of all the other policies. So we think it's critical, though, that people focus on the fact that the Trump policies are actually deflationary / recessionary. So firing like 1 million, federal workers, that's going to, at the margin, slow the economy. Import taxes, rather, are like a sales tax. That slows the economy. So we think that's going to force the Fed to realize that they've completely misanalyzed the economy as usual. Instead of the Trump policies being inflationary, they're really deflationary. And they will cut rates and will avoid a recession. But it's dangerous. The Fed's 2 years behind. And so that's kind of the key risk. The data is going to make it really obvious, so they'll probably figure it out.
I want to get to your stock picks, but before we do that, you think the Fed needs to be reformed. And if I understand correctly, you believe Donald Trump, the president, does have the authority to fire the Fed chair. Do you think he should do that?
Well, yeah, just specifically, the Fed chair can't be removed just because of current policy. But he did create the 21 great inflation, which is clearly incompetent. And the law in the U.S. or case law makes it very clear he could remove him. But I would only think it's prudent to remove him if they, not just to get another bureaucrat in there, but to reform their policy framework, because it's too focused, dangerously focused on the 2% target, which is completely made up. It also uses an index that's 2 years behind what's really going on in the market. So we have a very, very dangerous Fed. Just firing the Fed chair wouldn't do it, but we need to reform that horrible framework.
Okay. Two stocks you like in this environment are two of the giants of the Wall Street money center banking sector, Goldman Sachs and Morgan Stanley. Talk to us about that.
Yeah, so I think what a lot of people don't appreciate, like it sounds glamorous to be an investment banker. This is an old investment banker tie, so I know. But it's a tremendous amount of work. So if there's a new regime with better antitrust enforcement, it's not like you can just go out and announce, 10,000 mergers. There's 6 to 9 months of work that needs to be done. And so we think that pipeline is building. And then also hasn't really been discussed, but the same thing with AI IPOs. The companies need to develop a little bit. There's like 6-month window to get all the filings done. And so we look at the second half as like a massive investment banking boom. And we're carrying earnings estimates that are 30% above consensus because we think we'll get not quite to, but close to peak investment banking revenue.
Jay, thank you a great deal for this conversation. That's Jay Hatfield, founder, Chief